I'm Ashlyn Bennett, matrix number 269433, and I'll be explaining the definition of adverse selection. The main definition of adverse selection is that it occurs when products of different qualities are sold at a single price because buyers or sellers are not sufficiently informed to determine the true quality at the time of purchase. This means that when there is asymmetric information, which also means unequal information between the buyers and sellers, it distorts the market and leads to market failure. As a result to this, too much of the low quality product and too little of the high quality product are sold in the marketplace. For example, these are two given scenarios related to buyers and sellers and the information they have. Firstly, let's look at buyers. So buyers of insurance may have better information than the sellers regarding the insurance. So this means that those who want to buy insurance are more likely to make a claim. Therefore, firms are very reluctant to sell insurance in fear that they may lose out in the long run. This is because that when the consumer knows and has relevant information regarding the insurance, they would most definitely use that information for their benefit to make the claim of the insurance, which in turn causes the firm to lose out in the long run. Next, let's look at the sellers. Second-hand goods sellers may have a greater understanding of the genuine quality of the item than most customers do. Due to the consumers not having enough information for the product, they are hesitant to pay a fair amount because they are scared that they would not receive the product of good quality. Next, let's look at adverse selection explained for insurance. According to a life insurance firm, people who are at higher risk of death are more likely to acquire life insurance. However, if the insurance company charges an average price, but it's only for the consumers with high risk, then the company is sure to make a loss in the long run. Also, if the life insurance company charges a high premium account for high-risk individuals, young, healthy people will not purchase it because the cost is greater than their perceived value. Because most youngsters believe if they are not in the risk of health, then why buy insurance that is so expensive? Also looking at another scenario, according to a car insurance firm, those who live in high-risk crime areas are more likely to buy car insurance. And if that company charges the average cost, it can lead to the company losing out in the long run because they're only charging the average cost to high-risk individuals. Next, let's look at adverse selection for buyers. It is quite possible that the sellers would have better or more information compared to buyers, and they would only sell the products when it's favorable to them. For example, managers of a company may be more willing to issue shares when they know that the share price is overvalued compared to its real value. Therefore, buyers can end up buying overvalued shares instead of normal valued shares. Another example is the second-hand car market. The seller may know about an invisible defect and implement extra charge onto consumers who are badly informed. This can lead to a very bad situation wherein second-hand car markets are mostly built up by people who are selling bad cars or cars that are not really good of quality. Because if you have a good car, you wouldn't really want to sell it because the average market price is depressed by the number of bad cars in the market.
Moving on to the consequences and solution of adverse selection. So there are a few consequences of adverse selection. One of it are due to poor information and difficulty selecting customers, there will be a higher overall price as firms have to consider relatively higher payouts to high-risk customers taking out insurance. And so because there will be a higher overall price, This will lead to the second consequence, which low-risk customers may not want to buy because it is too expensive for their needs, leading to a missing market. So, let me put it this way. Let's say company ABC is a insurance company, okay? So we have Ali, who is a skydiver, which is also a high risk customer, and we have Abu, which is a teacher, and he is a low risk customer, right? So Abu would not feel it is fair if the company puts the same price for Ali and Abu, because Abu feels he is a low risk customer and he deserves a lower price as compared to Ali, who is a high risk customer. And next, firms may invest considerable time in identifying which groups of consumers are higher risk. So to identify which groups are high risk and which group are low risk, it is very time consuming. There are solutions to adverse selection. Firstly, firms need to try and identify different groups of people. Although it is time consuming, but this is one of the ways for firms to overcome adverse selection. So firms need to identify different groups of people depending on several factors like age, um, health issues, occupation, and etc. So these different groups of people would have different rates of insurance. For example, smokers, or like I mentioned just now, skydiver, who are high-risk customers, would have to pay higher price compared to people who don't have health issues, or people who are a low-risk customer. Next, government can implement compulsory purchase of insurance, which means all the low-risk customers and high-risk customers would have to purchase the insurance, or else they would have to pay tax premium. So it's either purchasing insurance or paying tax premium. The idea of this is to encourage people to join the insurance pool and to expand the insurance pool.
Hello everyone, good morning. I'm Ishan Subramaniam and my matrix number 270807. Now I'm going to continue with application of adverse selection in market for lemons and market for used cars. Okay, now we are going to see definition of market for lemons. So what is lemon? A total disappointing investment wherein your expected go back isn't always even near being achieved, costing some or all of the capital committed, which is that investment, that money we used for buy something is totally waste. That thing that we bought is not achieving our expectations. That is lemons. So what is the lemons problem? Issues that arising regarding the value of an investment or product due to asymmetric information provided by the buyer and the seller. So asymmetric information, as my friend explained just now, is the buyer is having a less information than the seller. So the same problems having in lemons problem too. So lemons are consist in market for used car, market for insurance, and market for credits. In this kind of markets, we can see lemons problem. Okay, now we are going to see market for used car. In this market, there are two individuals involved, which is seller and buyer. So who is seller? Seller have more information about a car compared to a buyer because they know more information about the car and they are car experts. And usually sellers give more importance to a price compared to a value. The another individual is a buyer. So buyer usually have low information about a car because they are not expert of car, and buyers will buy a car when the value of the car is more than the price. Okay, let's say in a market there is a high quality car for 10,000 and low quality car for 5,000. For your information, in America, low quality car mentioned as lemon and high quality car mentioned as plum or cherry. Okay, back to the lesson. In this situation, a buyer couldn't find which one is high quality car and which one is low quality car because he not enough of information of the car. So the buyer are not willing to pay 10,000 to buy a car because he is not confident which one is which. So he will look the two type of car in the same range, which is medium quality car. So he will offer some amount in the middle of 10,000 and 5,000, which is 7,500, because the odds are 50-50 to be a high quality car. So what the seller will do, due to seller giving more important to a price, he will not sell a high quality car to a buyer because the amount he offer is lesser than the actual price of high quality car. So he will sell a low quality car to a buyer. So if this will continue, the seller will not sell a high quality car to a buyer, and the high quality car will remove from sell. So buyer will get low quality cars at the end. So what will happen? The market end up low quality car drive high quality car out of the market. Okay, now we are going to see the situation I explained just now in a graph form. So we from the graph we know that high quality cars at price 10,000 sold is 5,000 cars, and at for the low quality at 5,000 price the sold car is 50,000. So as I said, due to buyers couldn't tell which one is high quality and which one low quality, they will assume that as medium level quality. So from this graph we know that the medium level quality cars sold at price level 7,500. So the fewer high quality cars sold, which is 25,000 amount, and more low quality cars sold for 75,000. So from after this, a consumer being to realize that most sold car is low quality cars, and the graph shows the new demand curve with new demand curve is DLM, which means that on average cars are thought to be low to medium quality cars. So demand curve shift to left, pushing the mix of the car even further towards low quality cars. This shifting will continue until only low quality cars are sold at the market price would be too low to bring any high quality cars for a sale. So the only relevant demand curve will be the DL. So what I'm going to say is, in future you guys wanna buy a used car, try to avoid lemons. So that's all from me. Thank you. I'll pass my friend.
Hi everyone, I'm Minasan here. Now I will explain about how asymmetry information and adverse selection take place in the market of insurance and market of credit. As mentioned earlier, adverse selection refers to a scenario where one of the participants in the market has better information than the other, which will lead to market failure. In the market of health insurance, people who buy insurance know much more about the general health than any insurance company can hope to know. In the insurance market, higher prices are charged to higher risk individuals. For example, a person who smokes regularly is charged higher price for life or health insurance coverage than a person who do not smoke. From the seller's point of view, everyone is of the same average health. Hence, they will charge an average price for all customers. Healthy people will choose not to buy the insurance as the cost of the insurance, which is the average price of the insurance, will be greater to them than the expected benefit. Hence, unhealthy people are more likely to buy the insurance than the relatively healthy people. This eventually increases the proportion of unhealthy people among insured people. Now the average price of insurance will begin to be based on the unhealthy people, which will cost higher than the initial average price. As the price of insurance increases, more healthy people select not to purchase the insurance. This further increases the proportion of unhealthy people among the insured, thus forcing the price of insurance up more. The process continues until most people who want to buy the insurance are unhealthy. At that point, insurance becomes very expensive. Or in the extreme, the companies will stop selling the insurance, which will lead them to a large number of loss. Adverse selection can make the operation of insurance markets problematic in other ways too. Let me give you another example. Let's say a company insuring cars selects a target population of men under age 25 to market their policy, and it estimates that the probability of an accident for people in this group is 0.1. However, since the insurance company has less information compared to the consumers, the estimation can go wrong. As for some of these people, the probability of having an accident is much less than 0.1, and for others, it is much higher than 0.1. If the insurance company cannot differentiate between high and low risk men, it will base the premium, which is the price of the insurance, on the average probability of 0.1. Those people with low probabilities of having an accident will choose not to insure, as they will find that the cost of the insurance is greater to them than the expected benefit, while those with high probabilities of having an accident will purchase the insurance. This in turn raises the accident probability among those who choose to be insured above 0.1, forcing the insurance company to raise its premium as higher prices are charged to higher risk individuals. In the extreme, only those who are likely to be in an accident will choose to insure, making it impractical for the company to sell their insurance to the other customers. Besides market of insurance, asymmetry information and adverse selection also can occur in market of credit. By using a credit card, many of us borrow money without providing any collateral guarantee. Most credit cards allow the holder to run a debt of several $1,000s, and many people tend to hold more than one credit card. Credit card companies earn money by charging interest rate on the debit balance. There are always two types of borrowers: high quality borrowers, borrowers who pay their debts, and low quality borrowers, borrowers who don't pay their debts. But how can a bank or credit card company differentiate high quality borrowers from low quality borrowers? In this case, borrowers have better information. They know more about whether they will pay the loan or not than the lender does, and this is where the lemon problem arises. Low quality borrowers are more likely to want credit than the high quality borrowers, which forces the interest rate up. This is because credit card companies tend to charge higher interest rate to compensate for carrying more risk. High interest rate will reduce the number of high quality borrowers, as now they need to pay back a larger amount of money. On the other hand, this will increase the number of low quality borrowers who don't pay debt, which again increases the interest rate up further, and the process continues. This problem prevents credit market from operating effectively. Hence, it cannot be denied that the asymmetry information and adverse selection can cause many obstacles in a particular market, which eventually lead to huge market failure. That is all from me. Thank you.
Hello everyone, I am Ashley and Edmund, my matrix number 271970. Today I will be continuing my part of importance of reputation and standardization. Okay, asymmetric information is also present in many other markets. Here are some examples of markets. The first one is retail store. How do you know will the store repair or allow you to return a defective problem? The store knows more about its policy than we do. The second, dealers of rare stamps, coins, books and paintings. How do you know if all the items are real? The dealer knows much about their authenticity than you do. Third market, roofers, plumbers and electricians. If a roofer repairs or renovates the roof of your house, do you climb up to check the quality of the roof? Definitely not. The following market, restaurants. How often do you go to the kitchen of a restaurant to check whether it's the fresh ingredients are being used or obeying the health of laws? In all these cases, the seller knows much more about the quality of the products than the buyer does. Sellers of high quality goods and services have a big incentive to convince consumers that their quality is needed high. From the example markets given earlier, this task is performed largely by reputation. Let me explain what does it mean by reputation in a task. Why do you shop at a particular shop? Because it has a reputation of servicing its products. Why do you hire particular roofers or plumbers? because they have reputations for doing good work. Next, why do you go to a particular restaurant? Because it has a reputation of using fresh ingredients and nobody you know has become sick after eating there. Besides that, Amazon and other online vendors use another model to maintain their reputation. They allow customers to rate and comment on their products. The rating and commenting features reduces the lemon problem by giving customers more information and motivating vendors to upload their end of the bargain. However, it is impossible for a business to develop a reputation. For example, most of the customers of highway diners or motels go there only once or infrequently. Therefore, the business has no chance to develop reputation. So, what are the ways in order to solve this lemons problem? The one way that can be solved is by using standardization. For example, if there's a McDonald's at your hometown, you may not prefer to go there regularly. But a McDonald's may look more attractive when you are driving on the highway. Why is it so? Because McDonald's provides a standardized products, which are the same ingredients are used and the same food is served in every McDonald's anywhere in the country.